Hello, this is Rich Vessel, founder of Advanced Projections, here with our September 2023 economic report. Please note that this month's report has been slightly delayed as we awaited the FOMC meeting results and new leading economic indicator data out this week. Here's our review of the economic data highlights for August and early September of 2023. Employment figures for August came in with another decent new jobs figure, up 187,000, matching last month's, with unemployment moving up a bit from 3.5% to 3.8%. We still expect unemployment to gradually move upwards. At these low levels, we continue to expect the Fed staying fully focused on inflation, given this as permission for further rate increases if necessary. Employment is a lagging indicator in the business cycle, so it typically declines after a downturn has begun. The annual CPI inflation through August was announced on September 12th, with the actual reported value being 3.7%, 0.1% above expectations, and significantly above the figures for June and July. Additionally, the core CPI that leaves out volatile food and energy prices was still at 4.4%, and sticky price inflation, less food and energy, continued higher in August at 5.5%, which is still about 2% higher than the more generally watched headline CPI number. As oil prices have gone up over the past 2 months, recently breaking above $90 per barrel, it will further add to the CPI headline inflation numbers in the months ahead. Federal Reserve FOMC paused their rate hike program again this month after increasing their Fed funds rate on July 26th, so this key interest rate remains at 5.25% to 5.5%. Now, we had expected them to implement another increase as inflation and employment numbers from July provided prompts to do so. Since they declined to raise rates this month, it is highly likely they will raise rates once more in early November or mid-December, within their next 2 FOMC meetings. To end this quarter, they've issued a new set of dot plot projections for 2023 through 2026, and they've again projected yet a longer fight against inflation with higher rates for a longer duration than they had previously indicated only 3 months ago. The continuing solid employment picture is likely to confirm that scenario. In June, the Fed essentially promised 2 more rate hikes in the second half of 2023, and July delivered the first. Now it's just a matter of when the next one arrives. We tend to gravitate towards November, given recently increasing oil prices and upticks in inflation. The S&P 500 remains solidly in bubble territory. The bond market reveals that smart money is still paying more attention to the Fed's signals and pronouncements. A small pullback in August has continued here in the first half of September. Note, in early July, our proprietary equity EKGs showed extreme overconfidence, even more so than in the fall of 2021. This is usually a sign of a major market top within 1 to 3 months of that reading. With the S&P 500 and NASDAQ down about 2% during August, recent market behavior in early September is again showing index price weaknesses coupled with high overconfidence. This week's FOMC meeting appears to have stuck a pin in the confidence bubble, and we expect further declines through the end of 2023. Our indicator system keeps our recession risk level at 90% plus due to declining leading economic indicators, continuing hawkish Federal Reserve monetary policy signals, and ongoing red AP indicators. The one AP indicator showing yellow, APPM for precious metal, is there due to the collapsed price of rhodium. The APSI, which had continued to skirt the boundary between red and yellow up until mid-June, returned to full-on red at the end of June, as we expected that it would have done so in our prior report. Now, here are the underlying economic details. Year-over-year consumer price index increases and tight labor markets continue to characterize our economy. General expectations out just ahead of this August's CPI announcements were for 3.6% year-over-year inflation, and it came in at 3.7%. In July, the Federal Reserve completed the first of two rate increases promised for the second half of this year, as the underlying sticky inflation numbers are not coming down as rapidly, and employment has not yet turned to a negative trend. Consumers are still spending and have accumulated record amounts of credit card debt, now exceeding $1 trillion. Bureau of Labor Statistics reports that unemployment continues to remain well below 4% over the past year, now at 3.8%, with new job gains in August of 187,000. We had expected those gains to dwindle faster in the first several months of this year, but there is still no strong evidence of it yet. We are expecting to see a more significant trend of layoffs, perhaps to begin later on in 2023. We included the household data table from the Bureau of Labor Statistics showing the most recent employment situation. All employment numbers are still higher than a year ago, including labor force participation rate and the total numbers of employed persons. This currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so right along with their 12 rate increases in the March 22 through August 23 timeframe, and within their last available FOMC meeting minutes. Look for continued small increases when the Fed FOMC returns with its next steps this fall. Their January through August rate increases were below our expectations, but based upon their newly issued September report, we still do not expect any delicacy or wavering on their part here in the rest of 2023. Expect at least one more 25-point bump yet this year, either in early November or in mid-December, if there are no unwelcome surprises during the early fourth quarter of this year. Within recent months, one analytical group in the Fed has acknowledged the high likelihood of a recession beginning later this year. This is not just a collection of opinions on their part, but a result of their own economic models using just the actions of the yield curve as the model's main input. We have a couple of sets of charts from that group, the Cleveland Federal Reserve, and we show how the probability in their system, if it goes above 40%, basically it's a guarantee of a recession within a year. And we show the chart for the duration from actually around 1955 through current time period, showing that this is indeed the case. And then we have an expanded chart which shows what's been going on in the past 20 years with that same indicator. In the energy picture, OPEC and Russia recently agreed to an additional 600,000 barrels per day in production cuts to support prices for their oil. The markets responded by moving oil up over $91 a barrel until the Fed's new FOMC report, and then it retreated slightly to about $90. We'll keep an eye on global demand forecasts to see where oil could go over the next several months, but our expected volatile range for the next several months is $75 to $95 per barrel. If oil holds near $90 for any sustained period of time, $4 plus gasoline is back on the table for a while. This will certainly add to inflationary pressures again, just as has happened in the past month. And by the way, gasoline in California is up already into the mid $5 per gallon for regular gas. Now, there's a lot of yin and yang in the market forces that determine natural gas prices, but for now they have generally declined significantly from levels seen at the end of last summer. Production has overtaken demand again, even with the U.S. exportation of record amounts of liquefied natural gas in the past several months. This should also help relieve electric power production costs, as natural gas accounts for about 40% of the U.S. generation mix. The first 6 months of 2023 saw solar and wind power generate more electricity than coal did, as coal-fired generation declined further, with renewables and gas-fired plants making up the difference. Gas has provided well over 40% of America's electricity over the past 3 months, and renewable generation has also increased. Coal is expected to be only 16% of the power blend this year, declining to 15% next year, perhaps lower. The Energy Information Agency has revised their own projections for declining gas and electricity prices in the near future, which are likely to take place as natural gas supplies continue to increase. Another mild winter ahead could send natural gas prices back down to historic lows. Gasoline prices are expected to move up gradually through 2024, but that excludes any volatility associated with spiking oil prices or, conversely, a crash in oil due to recession. We have a link for the short-term energy outlook from the Energy Information Agency included in our written report. Now, in the equities market, equity analysts who used a bottom-up approach to their predictions are focusing on a return to earnings growth in the fourth quarter of this year. But if you look at the year in its entirety, earnings for 2023 will be little changed from 2022, which is certainly no excuse for market valuations re-entering bubble territory. More than half of the earnings growth for the fourth quarter is expected to come from just 4 companies in the S&P 500: Meta, NVIDIA, Alphabet, and Amazon. Now, this is per FactSet's most recent earnings outlook report. So our recent comments about their overly optimistic projections for the year are likely to become real by the end of the fourth quarter. The major idea here is that at this point in a business cycle, one should view analyst expectations very skeptically. FactSet had previously stated, along with their chart included in the report, which we marked in red, that the S&P 500 will likely report a decline in earnings for the third consecutive quarter in the second quarter of 2023. We had stated that an actual value for the second quarter would be down 3 to 5%, when an earlier summary of analysts said down 7%. The actual value for the quarter fell right in the middle of our predicted range at down 3.8%. Why was the decline more moderate? Because the so-called Magnificent Seven blew out their earnings growth numbers. In combination, they were up nearly 40% year over year. Now, we have some quotes from an article from Lipper Services. One is that the Magnificent Seven saw Q2 earnings of $67.1 billion, up 38.5% year over year and 11.4% quarter over quarter. This group, the Magnificent Seven, consists of Apple, Amazon, Alphabet, Meta, Microsoft, NVIDIA, and Tesla. And the second quote from their article is, looking ahead to the second quarter, Q3 guidance numbers, looking forward to the next quarter, Q3 guidance numbers have started off more negatively compared to last quarter. There have been 63 negative announcements compared to 32 positive announcements, resulting in a negative positive ratio of 1.9. The biggest takeaway this quarter is that for the first time since the pandemic, we saw fewer companies beat revenue expectations, which will be a concern given the debate around pricing power and how long that will last post-pandemic. Furthermore, real revenue growth, adjusted for inflation, was negative for the third consecutive quarter. Now, that's the end of their quotes. And we continue. These few equities have had an outsized effect on total earnings, and the index increases for 500 stocks. We feel this is a misrepresentation of the health of the broader market, and at some point the Magnificent Seven will cease to remain so magnificent. For index prices to be going up, while broader earnings are still in decline, doesn't say a whole lot about market wisdom. It says much more about herd behavior rather than logical equity pricing. The last push upward during June and July was driven almost entirely by retail investors flocking to technology stocks, in particular the Magnificent Seven, which we have claimed are outrageously overpriced. Over the past 6 weeks, the S&P 500 stayed above 4,500 after returning there in exceptionally high-risk bubble territory. However, August's 187,000 new jobs, along with virtually nil expectations for a September Fed rate bump, failed to bring new excitement to equity indices. There was continuing evidence of ongoing moves to cash as reflected in money market deposits and the intermediate term bond market. More people have clearly started believing in the resolve of the Fed in their protracted battle against the inflation dragon. The new Fed rate pause this month has not been met with the same stock market enthusiasm as we saw in June, because the Fed now also projects higher rates lasting well into 2025. Their projections released in this month's FOMC report shows increased expectations for rates in 2024 and 2025, each year up 0.5% over what they had projected just 3 months ago in their June quarterly statement. Additionally, the consensus among the voting members appears to evaporate for 2024 and 2025, with a very wide spread amongst the expectations of these members. We at Advanced Projections continue to expect a few more interest rate increases. One of the FOMC's voting members expects 3 more rate bumps. The rest generally say 0 to 2, which we expect will be accompanied by further general declines in equity and bond prices in the intermediate term of 2024 and 2025. A return from the current index level just below bubble territory to warm market levels would take the S&P down to about 3,650, and a correction to the mean would be near 3,100. Downside momentum selling could take the index down much more if panic sets in. The Fed states that they are still highly resolute in their attack on inflation. That means some significant rate hikes should still be expected. They have clearly stated what their targets are, that inflation has only slowly and so far just partially responded as needed, and they are dead set against the significant pausing or ceasing their program too early so as to avoid the mistakes last made in the 1970s. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and the breakdowns in this metric, which usually appear ahead of real economic downturns. The July number for this metric was up 2.9%, but in August, for the first time in 4 months, it declined by 2.9%. Adjusted for inflation, margin debt is down 3.3% month over month and 3.3% year over year. Still, some significant portion of retail equity traders were mistakenly thinking the Fed was done with its program of rate increases when the June pause occurred. This form of risk capital has clearly made some serious exits from the markets, down 40% from its recent peak. An equity market bottom could be near on a historic basis when margin borrowing declines a full 50 to 55% from its previous high. So there is still the potential for a further decline of around 110 to 150 billion to realize the full decline from the last high of $1.03 trillion in margin borrowing. Our estimate for a bottom in margin borrowing is shown in the markup of the chart, which we have courtesy of Advisor Perspectives. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.